We want to get to what's going on here in the U.S. markets in a second, but I do want to start off with China. More concerns here about weaknesses, I guess, overall about the Chinese economy. But when you look at the property sector, when you look at some of the moves that China, the government has taken or maybe not taken to try to stabilize things here, do you worry at all about the potential contagion risk for the second largest economy?
Yeah, it's less contagion risk that I'm focused on right now than just the absolute issues in China. And if I think about it, one of the things I watch most carefully on the Bloomberg terminal is just Chinese consumer confidence, which is basically a tiny bit off the record low. This is a survey that started in 1996. We bounced after the reopening, post-COVID lockdowns, and it's just fallen right back over to those all-time lows. And I think that's really driven by the real estate issues. I mean, if you look at the household sector in China, the single biggest asset on the vast majority of households' balance sheet is their house. Now, you might be thinking, well, isn't that true in the U.S. and Europe? Kind of, but not really. In the U.S. and Europe, we're really wealthy countries. We have a lot of financial assets on top of a house, like your pension plan, your 401k, et cetera. In China, really, the house is the nest egg. And what we've seen is home prices going down for the last 2 years across most cities in China.
Yeah, well, as Country Garden reels and Scarlet mentioned Zhangji, this now becomes more of a financial issue at a time where I think a lot of U.S. investors, and for that matter, European investors, have tried to diversify away from the Chinese market. And I'm wondering if that correlation that used to exist, where you saw weakness in the Chinese economy, that meant weakness for most of EM and even for some of the developed market. Is that correlation still there? I
think it's less correlated than it used to be. There's truly a linkage between Chinese infrastructure investment, fixed asset investment, real estate, and commodities. But the EM market has become much more diversified than it used to be. In the old days, we thought of EM, you thought commodities and materials. That's really not the case anymore. So I do think that linkage is less strong than it used to be. But I do worry, by the way, I mentioned, household net worth and housing. These real estate developer issues are another problem. And the other one is really interesting is youth unemployment, officially at 21%. But some think tanks are now saying it might really be 45 to 50% youth unemployment because a lot of young people have just dropped out of the labor market. And just like in the U.S. and Europe, when you don't participate in the labor market, you don't count as being unemployed. So I think there's some real issues we need to watch in China. And so far, most of what the government has done has been tinkering around the edges. I think investors are waiting for that bazooka policy. I don't think it's going to come because back in the old days, it was almost always more credit.
Yeah.
The Chinese government doesn't want to pile more leverage on this problem.
Do you think China is trying to export its way out of this low growth environment?
I think they're using that tool, the currency tool. I mean, the currency is now down 8% since January. But China's economy is much more service-oriented and domestic now than it used to be. So even that tool doesn't work like it used to. So I think the Chinese policymakers have a real conundrum on their hands.
So what does this mean for U.S. companies, European companies with big operations in China, or that at least depend on that market for a big chunk of their sales?
I think it depends on what they're doing, right? I mean, what we've seen is the Chinese consumer did go back out and start spending money after the COVID lockdowns ended, but they haven't been making big ticket purchases. So if you're hoping to sell a car in China, that might be more challenging than if you're selling a basic consumer product. And so I think it's going to really depend on that. And I do think a lot of companies also are thinking about their supply chains, given the ongoing geopolitical tensions. And by the way, the fact that Chinese workers just aren't as cheap as they used to be. Wages have gone up a lot in China, and there might be better places to produce as well outside of China from a labor cost perspective.
With all the focus on China, of course, there's still a big focus on what's going on here in the U.S., an economy that I guess is still standing strong. Is that how you would interpret it?
Yeah, it's tough. I think it's always relative to expectations, right? I mean, if you told me 15, 18 months ago the Fed would raise rates 525 basis points and shrink their balance sheet $936 billion, I would have said, wow, how bad's the recession? And it is amazing, if you look at the second quarter GDP at 2.4%, how resilient the economy has been. And I also think the Fed is successfully threading the needle. Inflation is down from 9.1% to 3.2%, and yet we're creating 258,000 jobs per month year to date, which is twice what we need given population growth. So things are looking good. That said, even if we dodge a recession next year, I think people need to be a little more grounded and recognize we're still going to have really slow growth. I mean, consensus is 60 basis points of real GDP next year. If we get lucky, is it 1.5? That's still pretty slow as all of these tightening effects work their way through the economy.